Welcome back to Get Rich Education. We're talking with Victor Menasce. Of course, the Fed has been having their rate hike palooza. So really, my thoughts macroeconomically, does it make more sense for the free market to set interest rates rather than Jerome Powell in the Fed assigning interest rates and changing them at will and having central bank control over those interest rates? Because if we think about an economy and in a free market economy, consumer goods, everything from a 5-pound bag of Domino sugar on the grocery store shelf, that price is effectively set largely by the free market, all the way to a brand new 2023 Nissan Rogue SUV. So we can think of interest rates, therefore, as the cost of money, not the cost of sugar or not the cost of an SUV. So therefore, can the free market, or should the free market be dictating these interest rates that the Fed sets? How would that work?
Well, I think that, in fact, that the market is setting those rates, not the Fed. So what happens is the Fed sets a rate for their very short-term debt. But when you actually look at the way the banks assign an interest rate to a new loan, it's based on the market yield on the 10-year treasury. So even though the Federal Reserve only makes an announcement once every 6 weeks, those mortgage rates are fluctuating daily, hourly. They're fluctuating continuously because the marketplace is saying, here's what we want to pay for that 10-year treasury. It's been the marketplace that's actually been dictating what that yield is by either assigning a risk premium or saying those treasuries are worth more or less. So those are market forces at play.
Well, I'm really glad that you brought this up, because I've been informing my audience that the Fed funds rate does not move in direct lockstep with the 30-year fixed rate mortgage. It's more tied to the yield on the 10-year T-note. And historically, the spread on the 30-year mortgage is about 1.75%
exactly
above the Fed funds rate. Can you talk to us about that spread and why currently that spread is substantially higher, probably reflecting a risk premium from the banks?
Well, there's a risk. There is a spread, and then on top of that, you've also got a mortgage insurance premium. So, because when you are working with an agency and you're getting non-recourse debt, now again, the world of residential is different, but in the world of commercial, if you're getting non-recourse debt, essentially what's happening is that agency is becoming the guarantor on the loan. Whether it's Fannie or Freddie or HUD or whoever it might be, is acting as the guarantor. So in that situation, they will often charge a mortgage insurance premium on top of that spread. So it's typically a 1/4 point, maybe a 1/2 point. And we see the same thing in Canada. Canada has an analogous facility called the Canada Mortgage Housing Corporation, CMHC, which kind of fulfills a very similar role to HUD in the United States, and it's a very similar type of process.
So I think what you're telling us really is mortgage interest rates are somewhat of a hybrid between policy that the central bank sets and the free market.
Exactly right. That's exactly right. And it makes sense, because if you think about it, I mean, typically these lenders want to be in first lien position. They don't want anyone in second lien position. They want absolute security. And so that they can control their risk. If you want the very best rates in the marketplace, then the only way you're going to get that is if the lender is dealing with a known quantity within a very narrow set of parameters that they get to set.
You're listening to Get Rich Education. Our guest is Victor Menasce. I'm your host, Keith Weinhold.